Welcome to Florida, the Sunshine State. It's a place famous for its beautiful beaches, sprawling theme parks, and of course, its perplexing ability to be the punchline of a national news story at any given moment. But beyond the headlines about Florida man and rogue alligators, there's a much more serious and far-reaching issue quietly brewing. It's a problem that affects nearly every resident, from the long-time retiree enjoying their golden years in a paid-off bungalow to the young family desperately trying to buy their first home. It also impacts renters, whose payments are influenced by their landlord's tax bill, and small business owners trying to keep their doors open. If you live or work in Florida, this system affects your bottom line. We're talking about Florida's property tax system. It's a labyrinth of rules, amendments, and statutes that was designed with good intentions, but is now creating deep and painful inequalities across the state. The system is a patchwork of amendments and exemptions. Understanding it means deciphering terms like ad valorem and millage rates, a language that can feel intentionally obscure. This isn't just some boring topic for accountants and policy wonks. This is about real money leaving your pocket. It's about the fundamental fairness of who pays for our schools, our roads, and our first responders. The system as it stands is creating winners and losers in a game that none of us signed up to play. Imagine living next door to someone in an identical house, yet you pay thousands of dollars more in taxes each year simply because you bought your home more recently. Let's make it real. Take two identical homes valued at $500,000. A neighbor who bought 20 years ago might have a capped taxable value of $250,000, paying around $5,000 in taxes, but a new owner is assessed near the full market price, their bill closer to $9,000. That's an extra $4,000 a year for the exact same house. This isn't a hypothetical, it's the daily reality for countless Floridians. This disparity is stretching family budgets to their breaking point and making the dream of homeownership feel more like a financial nightmare. The core of the problem lies in rules that were written for a different era. Decades ago, Florida's housing market was a much calmer, more predictable beast. Lawmakers created policies to protect homeowners, particularly seniors on fixed incomes, from sudden, shocking tax hikes. The most famous of these is the Save Our Homes Amendment, which puts a strict cap on how much the taxable value of a primary residence can increase each year. On the surface, this sounds like a great idea. Who wouldn't want protection from skyrocketing taxes? And for new homeowners, the first step is the critical homestead exemption. You must apply with your county by March 1st to get a deduction of up to $50,000 from your property's value. A common pitfall is assuming it's automatic for new owners. It's not. Miss that deadline and you lose a full year of savings. Then there's portability, which allows longtime homeowners to transfer their tax savings to a new home. It's meant to help mobility, but it further benefits those who have already profited from the system for years, while new buyers start from scratch. But these well-meaning rules have collided head-on with the explosive, volatile housing market of the 21st century, creating a mess of unintended consequences. The result is a deeply fractured system. It's a system that shields one group of homeowners while leaving others completely exposed to the full force of market bubbles and rapid price inflation. As home values have soared in recent years, driven by a flood of new residents seeking sunshine and remote work, plus heavy investor speculation and changing climate patterns, the gap between the protected and the unprotected has widened into a chasm. This isn't just a minor flaw in the tax code, it's a structural failure that is actively undermining the financial stability of Florida families and distorting the very fabric of our communities. This distortion creates resentment between neighbors and makes local governments dangerously reliant on taxes from new homeowners to fund services for everyone. If the market cools, it can lead to budget shortfalls for schools and fire departments, affecting the entire community. Today we're going to pull back the curtain on this broken system and explore what's really going on. At the heart of Florida's property tax system is the Save Our Homes Amendment, or SOH. This isn't just any law, it's a constitutional amendment baked into the state's foundational legal document. Changing it requires a massive statewide effort and a supermajority of voter approval, making it an incredibly durable feature of Florida life. Passed by voters in 1992, its goal was to provide stability for homeowners. Before the vote, Florida was in a real estate boom. Property values and tax bills were soaring. Longtime residents, especially those on fixed incomes, found themselves in a terrifying position. They faced being taxed out of homes they had owned for decades. The amendment was a direct response, a promise that your home wouldn't be lost simply because your neighborhood became more desirable. The mechanism is simple in concept, yet profound in effect. It hinges on the difference between a home's market value and its assessed value. SOH limits how much of a primary residence, a homestead, can increase each year for tax purposes. That annual cap is 3% or the rate of inflation via the Consumer Price Index, whichever is lower. In a year with high inflation, the cap is 3%. In a year with low inflation, it could be much less. This cap creates a powerful shield, insulating homeowners from real estate market volatility. But here's the critical part. This shield only applies as long as you own and live in your home. The moment a house is sold, the protection vanishes. When a property changes hands, the assessed value is reset to the current market value for the new owner. This reset is the engine of the system. It means a new buyer starts from scratch, paying taxes on the purchase price, while their neighbor benefits from years of accumulated SOH savings. Let's look at an example. You bought your Florida home years ago for $150,000. A decade later, a real estate boom hits, and your home's market value skyrockets to $450,000. Without Save Our Homes, your tax bill could triple, potentially forcing a sale. But with the SOH cap, the assessed value used for taxes only creeps up by a tiny percentage each year. This creates a growing gap between market value and the value you're taxed on. This leads to a common Florida phenomenon: two identical houses, side by side, with wildly different tax bills. The long-term resident might have an assessed value of just $210,000. Their new neighbor, who just bought the house next door for $450,000, has an assessed value that matches that price. The new neighbor could be paying thousands more in property taxes each year. So how do you get this benefit? It's not automatic. You must apply for a homestead exemption with your county's property appraiser. The property must be your permanent residence as of January 1st, and the deadline to file is March 1st. Missing it means waiting a whole year. You'll need to prove it's your primary home, usually with documents like a Florida driver's license or voter registration card showing the property's address. It's a crucial step many first-time homebuyers overlook. There are also pitfalls. A common one is losing your exemption. If you rent out your homesteaded property, it no longer qualifies as your primary residence. You must notify the property appraiser, and your SOH cap will be removed. The assessed value can then snap back to full market value, leading to a massive tax hike. Another misunderstanding is that SOH caps your tax. It doesn't. It only caps your assessed. Your final bill is calculated by multiplying that value by the millage rate set by local governments. If they increase the millage rate, your tax bill will still go up. This system created the golden handcuffs, where homeowners were reluctant to move for fear of losing their tax savings. To address this, lawmakers added portability. Portability lets homeowners take up to $500,000 of their SOH savings and apply it to a new homestead in Florida. The idea is to reduce the tax penalty for moving, whether you're downsizing, relocating for a job, or finding a home that better suits a family's changing needs. It adds flexibility to a system that otherwise incentivizes staying put. However, portability isn't simple. The rules for calculating the transfer are complex, especially when downsizing. And like the initial exemption, it's not automatic. You have to file for it separately. It's a crucial, if imperfect, attempt to add flexibility to a system that profoundly shapes Florida's housing landscape. The immense benefits of the Save Our Homes cap are not available to everyone who owns property in Florida. They are exclusively tied to a special legal status known as a homestead. This isn't just a word, it's a financial shield, a coveted status that provides stability against the turbulent seas of Florida's real estate market. This isn't just a casual term for a house. It's a formal designation with strict eligibility requirements defined in Florida's statutes, particularly in Chapter 196. To qualify for a homestead exemption, and by extension the SOH cap, you must own the property and make it your permanent primary residence as of January 1st of the tax year. If you buy on January 2nd, you'll wait a whole year to apply, facing a full uncapped tax bill in the meantime, a costly surprise for many. The law is very specific about what a primary residence is. This means you can't claim a homestead on a vacation home, you can't claim it on a rental property, you can't claim it on a house you're flipping. The principle is clear: this tax relief is for permanent residents, not to subsidize real estate investments. It has to be the place where you genuinely live. The state needs proof, so it must be the address on your driver's license. It has to be the place where you receive your mail. It has to be the place where you are registered to vote. You're building a paper trail that proves this property is your life's home base. Establishing a homestead is a formal process. It doesn't happen automatically. A homeowner must file an application with their county property appraiser's office, typically after buying a new home. Critically, this must be filed by the March 1st deadline. Once approved, it generally renews each year, but the onus is on you to report any change in eligibility. That application is a declaration, under penalty of perjury, that the property is their one and only permanent residence. Property appraisers can and do investigate these claims. Fraudulently claiming a homestead exemption, for instance by also claiming a residency-based tax credit in another state, can result in steep penalties, paying back up to 10 years of saved taxes, plus a 50% penalty and 15% annual interest. It's a devastating financial consequence. The legal framework, like Florida Statute 193.155, lays out how the SOH cap is administered. It details procedures for appraisers when calculating assessed values each year. It also defines what happens when a property's status changes, for instance if a homeowner dies, gets divorced, or a new owner is added to the deed. Those events can trigger a reassessment or loss of homestead protection, resetting the assessed value to full market price. That reset wipes away the accumulated difference between capped and market value. For example, a home with a market value of $500,000 but a capped value of $200,000 will see its tax basis jump to the full $500,000 for the next owner, often causing a huge and unaffordable jump in the tax bill. These statutes were drafted in a very different economic climate. They assumed slower, predictable growth in Florida housing markets. They did not anticipate today's supercharged bubble and bust cycles. Now the legal machinery for gentle, predictable tax relief runs in an environment of extreme volatility. It's like using a 1990s computer to trade on today's stock market. That friction between old rules and new realities is where many of the system's failures begin to emerge. In addition to local policies, macroeconomic forces have played a huge role in shaping Florida's housing market. The Federal Reserve's money printing and low interest rates fueled a surge in home prices nationwide. Government-backed entities like Fannie Mae and Freddie Mac made it easier for banks to issue risky loans, amplifying the housing bubble. Meanwhile, the FHA has sometimes hidden the true extent of foreclosures by modifying troubled loans instead of foreclosing, masking deeper problems in the market. All of these factors have contributed to the volatility and inequality we see today. These national tides create powerful local currents, leaving homeowners to navigate the consequences.